Happy Monday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Europe, Asia, and North America. My name is Tony. It's going to be a big week, and today's episode is a big episode. Today's episode also contains this month's second sponsored feature. On Market Update, sponsored features are limited to just 2 longer-form sponsored features per month. This is to ensure that the channel is financially sustainable while reducing disruption to the viewer experience. If you'd like to know how I work with sponsored features, including today's, which I'm excited to introduce to you, this is all in the description below. Now, with that said, let's move into the first development. Global oil markets surged and investors braced for prolonged volatility following the United States' unprecedented bombing of Iranian nuclear facilities over the weekend, dramatically escalating tensions in the world's most critical energy-producing region. Now, of course, this was in the Middle East, but it was a US foreign policy decision, and the markets are very much global, so we'll be discussing it as a North American update today. The strikes carried out by 7 B-2 bombers using bunker-busting massive ordnance penetrator bombs targeted key nuclear sites in Iran. Though US officials initially framed the operation as limited, US President Donald Trump later suggested on social media that, quote, regime change, in quote, in Tehran may be on the table, intensifying fears of broader conflict and retaliation. Oil futures immediately reacted to the news, with US West Texas Intermediate WTI jumping 2.7% to $75.80 a barrel, and crude rising 2.44% in early trading. Crude briefly spiked to over $81 per barrel before easing slightly, reflecting heightened geopolitical risk in a region that accounts for nearly a third of global oil exports. The market's response was driven by concerns that Iran could retaliate by closing or disrupting the Strait of Hormuz, the narrow choke point through which over 20% of the world's oil, about 20 million barrels per day, flows. Iranian state media reported that lawmakers have backed the idea of closing the strait, although the final decision rests with the country's leadership. The Strait of Hormuz has long been considered the world's most strategically vital oil transit route. Any move by Iran to block or threaten shipping in the strait could trigger a global supply shock, causing energy prices to spike and inflationary pressures to rise, especially in oil-importing economies like the United States, China, and the European Union. Of course, it is the Chinese that are most vulnerable to this oil shock, as much of their oil comes from this region, and while the US would likely see painful short-term ramifications, it has the potential to be a net energy exporter, and so over the medium term would be in a far better position than, say, East Asia. The US imported roughly 500,000 barrels per day through the strait in early 2025, according to the US Energy Information Administration. China, which buys the bulk of Iran's 1.8 million barrels per day of exports, would be, of course, severely impacted. US Secretary of State Marco Rubio warned Iran that attempting to close the strait would amount to, quote, economic suicide, end quote, urging China to use its influence to dissuade Tehran. And indeed, closing the strait would be very painful for Iran itself, cutting off its main source of revenue. Beyond the immediate price shock, analysts say the oil market is now pricing in a risk premium over the possibility of further escalation. Iran's foreign minister declared that all options were on the table to defend the country's sovereignty, while the Revolutionary Guard warned that US bases in the region were, quote, vulnerable, end quote. Further complicating the outlook is the potential destabilization of Iran's regime under pressure from intensified US-Israeli attacks. If Iran descends into political chaos or civil strife, as was seen in Libya after the 2011 NATO intervention, its crude output could face lasting disruption. And of course, such chaos would likely spread in the region. Meanwhile, British Airways and Singapore Airways have suspended flights to Dubai following the US airstrikes, intensifying disruption to global air traffic. More than 150 carriers, including Air France, KLM, American Airlines, and Japan Airlines, have already rerouted or suspended flights due to closed airspace over Israel, Iraq, and Jordan. British Airways cancelled all flights to Dubai and Doha on Sunday, yesterday, and extended its suspension of Bahrain services until the 30th of June. A BA flight en route to Dubai was forced to land in Zurich after 9 hours in the air. Singapore Airlines also cancelled 2 Dubai-bound flights after assessing the security situation. According to Flight Tracker 24, the Middle East has seen over 3,000 daily cancellations since the conflict began, with airspace over Iran, Iraq, and Syria remaining mostly clear. European airlines were particularly affected, already avoiding Russian airspace due to the Ukraine war. While Israel briefly closed its airspace on Sunday, traffic has since resumed. For now, rerouting over Saudi Arabia and Egypt remains the norm as tensions persist across the region. Returning to oil, all major oil producers in the region are under the microscope. Iraq, OPEC's second largest producer, is vulnerable to spillover violence from Iran-linked militants, and although Saudi Arabia has largely stayed neutral, it expressed deep concern over the US strikes. The International Energy Agency has assured markets that global oil supplies remain stable for now, with 1.2 billion barrels in emergency reserves ready to be deployed. Still, the spectre of broader regional instability hangs over traders and consumers alike. Some analysts have warned that oil prices could jump as high as $100 to $130 a barrel. Such a development would likely throw the world into recession, though, as we discussed before, some nations and regions would be hurt much more than others. The US would feel the pain, but is in one of the stronger positions to weather such a storm. With tensions high and the geopolitical situation fluid, oil prices are expected to remain volatile. The market is now watching for Iran's response, and indeed they may have responded by the time this video goes live. A critical determination of whether this crisis remains contained or spirals into a full-blown regional war, with sweeping implications for global energy flows, and worse. As regular viewers know, critical minerals and commodity supply chains have been pulled into the ongoing US-China trade war, and the United States has accelerated efforts to bring critical supply chains back closer to home. This is something we have been following very closely for months now. The current US administration has signed several historic executive orders to protect copper production and mining on US soil. Copper demand is now surging, while supply struggles to keep pace with all this, while Washington is working to bring US copper production back home. Global mine production is expected to peak in 2026 with a projected 700,000-ton deficit in 2025 alone. Underinvestment in mines has created a supply crunch, and the US-China trade war has disrupted global copper supply chains. China controls 50% of global smelting. The world is hungry for copper, and this means big opportunities for savvy investors seeking to take advantage of this historic shift. And today's video sponsor, Giant Mining, provides such an opportunity. Giant Mining not only operates a silver, copper, gold project in Nevada, but also recorded its best ever drill intercepts in September of 2024. The company is the North American copper company to be watching. On the 14th of February, an executive order was issued that implicitly prioritizes copper as a critical resource. Nevada, where Giant Mining's copper project is situated, has consistently ranked among the top mining jurisdictions in the world. Giant Mining's balance sheet is now fully funded for its drilling programs in 2025. Giant Mining is well positioned to accelerate its exploration efforts and potentially capitalize on emerging copper market opportunities. The share price is down by 50% since February due to market turmoil, making it potentially a very cheap pick at the moment. Giant Mining owns the Majuba Hill copper project, a past producing mine. In the past 4 years, management and the company's geologists have actually expanded the copper deposit, and this past September, Giant Mining hit their best ever drill hole. The 2025 results are now on screen. David Greenway, CEO of Giant Mining, commented on these that Nevada continues to prove itself as a world-class mining jurisdiction, ideally positioned to support the America First policy and bolster domestic resource security. With global copper demand soaring, Majuba Hill offers a compelling, homegrown solution to help meet America's significant and growing consumption of copper. Most excitingly, Greenway expressed the following on drill hole MHB34. In my entire career, I've never seen drill core like this. It's truly extraordinary. When we began drilling MHB34, we had high expectations, but what we encountered exceeded them all. In my entire career, I have never seen drill core like this. The presence of visible native copper beyond 1,850 feet is a powerful indicator of the scale and strength of the mineralized system at Majuba Hill. This hole reinforces our belief that Majuba Hill is evolving into a world-class copper, silver, and gold discovery. So, well below its all-time high, a mining-friendly administration, copper coming back to America, and a serious asset in Nevada. Like any mining company, this is a speculative play. High risk, but also a potential very high upside. As such, Giant Mining is worth doing your homework on for any savvy investor seeking to take advantage of the historic changes we are seeing in the world today. Do your due diligence on Giant Mining. More information on this sponsored feature, including relevant disclosures, are in the description below. A big thank you to Giant Mining for sponsoring this episode of Market Update. We now return to regular coverage. Next up, with US President Donald Trump's sweeping global tariffs set to retake effect on the 9th of July, India is scrambling to finalize a trade deal that could spare it from a punitive 26% levy on exports to its largest trade partner. The looming deadline has sparked a fury of diplomatic activity, with New Delhi eyeing a fast-track agreement similar to its recently concluded deal with the United Kingdom. India's free trade agreement with the UK, its first with a major Western economy, slashed tariffs on 90% of UK imports and granted Indian exporters significant access in return. The deal, 3 years in the making, offered a template for how India might navigate complex demands from the US, including lower auto tariffs, digital trade liberalization, and stricter intellectual property rules. However, replicating that success with the Trump administration is uncertain. Despite announcing a first tranche of a US-India trade pact during Prime Minister Modi's February visit to Washington, little concrete progress has emerged. India's Commerce Secretary Sunil Bathwell remains optimistic, citing reciprocal visits and accelerated talks ahead of the 9th of July deadline. India's new trade strategy reflects a shift away from its traditionally protectionist stance. Analysts say the UK pact signals a willingness to meet Western demands, albeit cautiously. Still, hurdles remain, though. The EU, for instance, continues to insist on including carbon taxes and sustainability standards in negotiations, which India views as outside the scope of trade. Textile and garment exporters are hopeful. Quote, "The UK deal puts India in a favourable position," end quote, said a New Delhi-based garment exporter, speaking to Japanese financial media outlet Nikkei Asia. Large firms like Gokeldas Exports also anticipate a boost if the US deal materializes, but as the vice chairman noted, in the absence of clarity from the US president, the industry must brace for near-term costs. For now, India's hard-won deal with Britain serves as both a playbook and a litmus test. Whether Washington responds before tariffs hit may decide the pace and success of New Delhi's wider Western trade ambitions. And finally for today, we move to Europe. The BBC, the British Broadcasting Channel, has taken its first legal step against an artificial intelligence company, threatening to sue Perplexity AI for allegedly using its content without permission to train its models. In a letter sent to the CEO of the AI company, the British broadcaster claims it is proof that the startup's, quote, default AI model, end quote, was trained using BBC material, and demands the company stop scraping its content, delete all existing data, and propose financial compensation. The dispute is yet another example of growing tensions between media organizations and AI developers, many of whom rely on freely available online material to train their models. The BBC, which is publicly funded in the UK, is exploring potential licensing deals with major technology firms as it seeks new revenue streams amid ongoing cost pressures and negotiations over its 10-year charter renewal. Perplexity, a San Francisco-based AI search engine valued at $14 billion, denies the accusation, calling the BBC's claims, quote, manipulative and opportunistic, end quote, and asserting a fundamental misunderstanding of technology and IP law. While the company does train its own large language models, it refines outputs from Meta's Llama models and offers users access to outputs from OpenAI, Google, and Anthropic. The BBC alleges that Perplexity has reproduced its content verbatim and even indexed articles that were only recently published, bypassing BBC platforms and undermining its audience trust. Internal research by the BBC found that 17% of Perplexity's AI-generated responses containing BBC content had significant factual or contextual issues. Concerned about potential reputational damage and copyright violations, the BBC has begun registering content with the US Copyright Office and stated that it is entitled to statutory damages for unauthorized use. This lawsuit will likely be the first of many between traditional media, some call legacy media, and AI models. With tens of billions of dollars on the line, players from both these massive global industries will likely be fighting it out in the courts for some time. The outcome of those legal decisions will impact the development of AI and the global media landscape, potentially for generations to come. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Monday, have a productive week, and I will see you for a new episode tomorrow.